What's up, everyone? Welcome to another episode of Portfolio Talks, episode 8. And today we're going to switch it up a little bit. So instead of just talking about a topic, what we decided to do this episode is give you a real life case study for a client that we just had, who is a 38-year-old physician that earns a high income and is running into a lot of the same problems that you'll be running into as you listen to this episode. There's a lot of similarities. The questions we've been getting on the podcast, questions we've been getting on our social medias are all more or less about the same stuff. So we wanted to do a little switch up and talk about that stuff today. So we're going to talk about this physician's case study, but make sure you turn on post notifications, subscribe to the podcast. Not only does that help us on the ranking side, but it also helps you learn and know when we put out these episodes, because sometimes as much as we want to stick to a schedule, things happen. We get busy. There's World Cup, there's travel plans, whatever it may be. So sometimes we will miss that Monday, but if it's on a Wednesday, you want to get that notification right away. So if you want to make sure you keep on learning all the things you need to learn to improve your finances, make sure you hit subscribe on whatever platform you're watching, and let's jump right into it.
Hey, getting money is my job. Come and pull up to Portfolio Talks. Hey, paper stacking around the clock. Time to pull up to Portfolio Talks. Yeah. Portfolio Talks. Hey, Portfolio Talks.
All right, everyone, we are back. Episode 8, Portfolio Talks. You got Vishal Gill, financial planner at Portfolio Planning. Tyson Nagasaka, the boss, the brains behind the operation at Portfolio Planning as well. Not only is he a great golfer, not only is he handsome, he's a great podcaster, I think is the way you say that. We're a little bit off schedule today. We're posting and recording this on Wednesday. It's just been a crazy last couple of weeks. I had some travel plans. I was selected to go to a conference in Montreal for those of you listening on that side of the country. And it was beautiful. FIFA was bumping in Montreal, so vibes were elite there. But we're there for an industry event, so just kind of like, meeting with people across the country, brainstorming stuff in the industry, see best practices and some things that are coming down the pipeline so we can share it with you all, which is great. Then spend some time in Osoyoos for Father's Day with the family. And then we were both, Tyson and myself, were golfing yesterday. Was it yesterday? Yes, it was.
It was yesterday.
It was yesterday, yeah. I forgot the days for a sec. It was yesterday. I usually have softball on Mondays. That's why it kind of messed me up for a sec because it was Tuesday yesterday. But I was golfing for a charity tournament for Archway Community Center here in the Lower Mainland, who does a lot of great work. So great tournament, but it was smoking hot and had softball after. So very, very busy week, hence why we bumped it back a couple of days just to make sure that we can still get it up to you guys. But just another reminder, that's a great reason to subscribe to the podcast on whatever platform you're listening to, because sometimes things will be infrequent and then you'll get that nice little notification when the episode's up so you can listen to us on your commute or at the gym or whatever way you listen to your podcast. So before we jump into it, Tyson, anything to catch the audience up on? How was your golf? You were scorching out there too?
Yeah, it was smoking hot. Normally I don't mind that. I'm partly tropical, but we played just before twilight. So it was like 4:30 tee time and it was like peak heat. But it felt great. It was so hot. My knees felt great. Back felt great. Everything was working. And then I think any day you can get out of the office and go golf is a great day.
Absolutely. Did your driver work as well? You were just sending that thing?
No, I purposely did not play driver yesterday. I played long irons and 7-wood, and it worked out for me.
Good. Love that. I started off fading near the tail end. I actually teed off separately from you. I teed off at 12. So I teed off at 12. When I was halfway through, I was just like cooking. I looked at the temperatures. 35 felt like 37. I was like, that makes a lot of sense. And I was just fading near the tail end. I was like half swings, things were missing, but my misses were in the shade along the car path. So that was nice. Just very efficient golf. So drive along in the shade and then kind of hit it from there. But it's never a bad time to golf. So love it. Awesome. Okay, well, let's talk about something just as fun as golf, which is your finances. So as we mentioned before, we really want to switch up this episode and just do something a little bit different, which is just answering your questions that you guys all have, but in a case study based off a client who's a physician that we just had over the last month. And she's a 38-year-old surgeon, obviously has a great income, has some great retained earnings or extra money inside the corporation because she doesn't need all the money she earns for her personal lifestyle. So money ends up sitting in the corporation, which is quite normal for the user on this podcast. But, is that success or is that a future liability? And the way that you look at that is really going to be predicated on your knowledge on money inside your corporation. So that's what we hope to give you today, is a little bit more understanding on corporate wealth. Yes, it's a fantastic thing. Yes, you definitely need it for the most part. And learning how to navigate around the complexities of your corporation can benefit you exponentially in your career financially and prepare you for retirement. So let's kind of jump first into our Mythbusters. Then we'll talk about all the context of the episode, and then we'll finish off with some prescription pad with some questions just to kind of get you guys out of here. And then we're also going to be filming a special episode on SpaceX that will be coming out right after this. And that's something that's been obviously a landmark thing that's happened in the investment world of SpaceX going public. And what does that mean for you and your finances, if you held in your portfolio, if you're pre-IPO, all that kind of fun stuff. So first things first, once you get 7 figures in your corporation, you're set. That's a myth potentially that's been around for a while. And that's what we see a lot of times is people have the mentality of just getting to a certain net worth and a number. And once you get to that number, you're good to go. And it's funny, when we talk to these clients, a lot of them are like, oh, I remember playing this board game Life back in the day. I don't know how old everyone is listening to this, but I remember playing that game when I was younger. And there was this career card that you could get. You could either just start working right away in like blue collar, or you could go to school and become like a doctor. And if you got that doctor, I remember you make 150K salary. And the game of life, you're like, I'm set, 150K, I'm good to go. That is not real anymore. That game needs to be updated. But I think it's the same kind of idea, is once you get to a certain number, you just think that you're set. And although the number is great, it can also turn into a huge liability because your corporate money that's there is not tax-free. So let's kind of jump into the reality of that first. So Tyson, when it comes to that myth, once you hit 7 figures in your corporation, you're set. I know it sounds like the finish line, but for a lot of incorporated doctors, it could actually be one of the riskiest moments in your financial life because it's such a definitive time to make decisions and make changes. So is that a myth or is that true?
Yeah, I mean, I think it's a bit of both. It's a level of success that you've attained. So like we speak to students in a few different veins, in optometry and dentistry, and physicians that are going through their residency and like going to become a doctor. So they go to school forever. And if you think about it, you're 25, 26, 27 years old. You're just finishing med school. So you've been in school essentially for 20 years. It's a long road to like get to the other side to start practicing. Then you start making money. Like it, so you could be 30 years old and just really starting to make what you feel is like good income and saving money. Then you have money that's accumulating inside your corporation. And it does feel like success. Depending on who your accounting team is, they might tell you to hold all of your savings inside your corporation because it's lightly taxed corporate dollars, which they're not wrong. It's just early seasons in the whole wealth planning journey that we're on. So they're not wrong. Having money, having $1 million or $5 million or $10 million in your corp, it can feel like success, but there are additional conversations that have to be bolted onto that of what are we going to do? How do we look at this long term? And I think we're going to cover some of that as we go through the case study.
Yeah, definitely. And I think that's a perfect segue to kind of talk about what to do with your money. So yes, it's great that you have a net worth, but it needs some adjusting. And one of the first adjustments that we start to see when we work with our clients is the asset allocation. So what that means is where you hold your money. Is it in what types of investments? Is it dividends? Is it capital gains? Is it interest income? Is it cash? That's what asset allocation is. And for the most part, people understand conceptually that you want to have a blend of how you get your returns in that kind of allocation. So allocation of how you're taxed on your returns, what kind of investments you're having. So people have a general idea of that. They'll have okay, if I'm really risky and I don't need this money for a while, I'll go 90-10. And if I'm kind of in between, kind of risky, I'll go 80-20, there's 70-30, 60-40. And that's what people think when we ask them, asset allocation, where do you feel like you're at? So one common problem that we see is people don't have overall asset allocation. They'll have a 90-10 on their personal side and then the 90-10 in their corporate side, or 80-20, 80-20 on both sides, because they feel like they're 80-20 client or person, 80-20 person. So inside that corporation, it's a little bit different because the way that you're taxed on your returns. So Tyson, let's jump into that, and then let's talk about what kind of allocation people should have overarching when it comes to their entire financial plan. Is it 80-20, 80-20, or should it be 80-20 as a total? And where should you hold, the 20% versus 80%?
Yeah, that's a great question. It's a little bit of a conversation, but when we look at the client holistically, and I really hate that word because our industry is ruined the concept of that word. But if we look at the client in totality, their personal side, their family, their kids, their businesses, if they have multiple corporations, we do want to look at a 30,000 foot view of like, what are they doing? How are things allocated? What pieces are, because when it's fragmented, sometimes we see people that they're going to manage their personal assets on like a self-directed platform, right? Like a bank directed platform or a Wealthsimple or something like that, because they think being fee sensitive is a good thing. Cool. And then their corporate assets, they might deal with a private wealth firm or an investment broker of some kind. And they're only dealing with that particular piece of the puzzle. So when we zoom out, we're looking 30,000 feet. They might be doing the same thing in each bucket and feeling like you're diversified, but it could all be what's called correlated. It all rhymes the same way. So when the market goes up, it all goes up. When the market goes down, it all goes down. It doesn't really feel like good diversification asset protection. The other piece that we see is our most educated clients, lawyers, doctors, accountants, engineers, super smart people. They're not always financially literate. And so we do see some people that are extremely high income earning individuals, very smart, have cash instruments in their corporation, like GICs. We call them GIC refugees. The challenge with that is being so risk averse is your money's actually not keeping up with the pace or cost of living. And so if you're saving in year one and we're planning for retirement 30 years from now, the value or the spending power of those dollars is severely ground down in the future. The other thing is cash instruments, GICs, term deposits, whatever you want to call them. They're taxed at the highest level inside your corporation. So if you're making 3% on those, you're netting 1.5, and 1.5, when we use the rule of 72, your money's essentially never going to double. So we want your money to be growing. We want it to be tax efficient and sensitive to what's happening outside and inside the corporation. And I think this is where we really start to look at the layers of the cake, to make the perfect setup for the client. And really, a lot of it comes down to education. It's tax integration, but it's also team integration. Is you want your financial team to talk to your accounting team, maybe talk to your bookkeeper, and make sure that your goals and what you're doing all align, so that we're not avoiding tax, but we're doing it efficiently in each silo that we're working in.
Yeah. And one thing I always let people know is you're not just being taxed for the sake of being taxed on certain investments. So Tyson kind of talked about interest income, talked about capital gains and different types of returns that you'll get that get treated differently with tax. Tax buys you liquidity. So, not to say that you should always just defer tax. Sometimes it's okay to pay that tax. It's okay to have interest income. It's okay to have, capital gains. It's okay to have dividends or a blend of all of them, because now you have a laddered approach to your liquidity of your money or your access to your money. So tax isn't always necessarily a bad thing. It's where you hold that tax, where you get exposed to that tax, which can be a detrimental part of your finances. So to tie it back to our case study, our client, when she came to us, had about $1.2 million. And she was very much in that same mindset of, if I'm a 60-40 here on the personal side, I should be a 60-40 on the corporate side, because I'm the same person. My corporation is me. It's just a tax deferral part of me. So it's not the wrong idea, but she has 60-40. So because of that, at a 5% return on her portfolio, she was about $10,000 over that 50K threshold that we've talked about a couple times. For those of you who haven't heard our previous episodes, long story short, oversimplification, if you have $50,000 of passive income inside your corporation, you start to reduce your small business limit, which is the most favorable tax bracket in your corporation, at a 5 times multiplier. So for every $100 over the 50K, you lose $500 on your small business limit. So you're getting taxed in the general rate, which is the higher rate at an earlier threshold. So that's basically what that looks like. So for this client, she was $10,000 over the 50K threshold. So was starting to, ratchet down her small business limit, just because the way that portfolio was built. And she actually didn't necessarily need that much liquidity, because that's one of the first questions we ask when we look at the portfolio. It's not, hey, you're doing this wrong. It's, hey, maybe we're wrong. Let's get a better understanding. And one of the questions we asked her was, how important is liquidity to you inside your corporation? Like, how much do you need this money? And her answer was, I don't really need the money, because like when it comes to the tax bill, she my money that I earn, I do my quarterly deposits, which most of you do. So it's not really like she needs the money to pay for the tax. She didn't really need the money to pay for a down payment. She already had a home owned outright. So there was no large capital expenses that were happening. It was just for retirement. So she didn't need the liquidity. So that kind of shows us that, this portfolio might need a better allocation mix and might need some changes, because that's a good indicator. So sometimes people think, oh, like you should never have interest income inside your corporation. Yeah, it's not ideal to have interest income, but if you need liquidity, you at least you're having your money grow a little bit, as long as it's not hurting your overall financial plan. So just keep that in mind. Tax treatment is based on the liquidity of your money. So if you get access to your money, you're taxed at a higher rate. If you defer when you need that money, you get the more favorable, which is capital gains. I don't know if you have anything to add to that, Tyson.
Yeah, no, I mean, some of the sort of cliches that we've heard over the years is like, don't let the tax tail wag the dog. Some people are so afraid to make maneuvers and allocations because of the implications of tax. But
you'll pay tax anyways at some point.
You're going to pay tax anyway. You're going to pay tax eventually. But it could mean that if you are a balanced investor at that 30,000 foot view, maybe we're a little more conservative on the personal assets, and you could be a little more equity focused in your corporate portfolio, which means it's more in terms of the capital gains growth, the future growth, so that you're not taxed every year on what's happening, and you can decide when you want to trigger some of those gains that are going to flow out to your portfolio and then out to your personal side. So it doesn't mean you're avoiding tax. It just means you get a little more levers to pull on, and when you can activate some of those things.
Yeah, and really the question is not like, your question isn't where should I invest, is what kind of income do I want this portfolio to generate? And that answer is not the same in your personal hands versus your corporate hands. That answer should be different because you're taxed very differently between the two. So, if your example with this client, this physician, if she's a 70-30 type of person, you can be a 70-30 type of investor, but it should be the entirety of your portfolio. The entirety of your money is a 70-30, and that 30% that is going to be your interest income. For example, let's say she did need some liquidity to her money. She's like, I don't even know. Like, I'm going to potentially buy this rental property or vacation property in the next little bit. So I don't know when that's going to be. So I need the liquidity side of it. Okay, cool. We can do a 70-30 and perhaps have the interest income portion that's going to be the liquidity in your TFSA. And then when you need to access that money, you can access it and you get that contribution room back in the next year, calendar year, plus whatever the new contribution room is, and then we can reallocate later on if now you have no longer goals. So, it's not bad to be a 70-30 person. There's no right answer, but if you need the liquidity and the 70-30 makes sense for you, look at where the 30% is most advantage to be in. And for this client, in that example, it was the TFSA made a whole lot of sense. But for you, it may be a little bit different. But 70-30 in the entirety of your situation, corporate, personal, 70-30 that way, not doubling your 70-30 and duplicating on the personal side and the corporate side. That can get you into some tax problems. And as we mentioned, tax isn't the end of the world, but if you don't have to pay the tax and you're just doing it by accident, then that doesn't make a lot of sense either. Awesome. So switching over, we want to talk about the compensation side of it. So we talk about this often. The way that you compensate yourself is going to change a lot of things for you in the later years. So the difference of tax filing versus tax planning. Tax filing is what usually happens to a lot of doctors is you're spending money throughout the year. By the time you do your personal taxes, April-ish comes around and you're, oh man, I spent a little bit more money. RSP season has already passed. So your only answer is really to do dividends because you haven't been doing your installments, or you did your installments but for lower income than you anticipated. So now there's no other solution to put the money besides, okay, just dividend out to yourself. You'll have a higher tax side on the corporate side, but you have the cash on the corporate side, so just pay the tax from here. And then you're all kind of cleared up. You can clear the shareholder loan. So, for a $1.2 million corporate balance sheet, it can be, a lot of money if you need to start paying yourself in this example. But the way you pay yourself will change things. So, the default is just dividend everything out. But let's talk about, for this client, what made more sense. Was it salary? Was it dividends, and why?
Yeah. I mean, for this client, and for a lot of our medical professional clients that are incorporated, it's a blend of salary and dividends that make a lot of sense. So when you pull the money out of your corporation, the excess money that you don't need, you have somewhere to put it, because drawing salary creates RSP room, which gives you a place to invest in a registered account on the personal side. So you get another tax deferral mechanism. So again, it is a tax deferral mechanism. It is not a tax eraser. But we're going to pay tax eventually, so we might as well get the most out of the dollars, be efficient with it, have it grow, and be there for the future. And like we always say is, you're going to need that money outside the corporation eventually. So doing it over a longer period of time is more advantage to a client than having a $20 million, balloon in your corporation and having to take all that out within a couple of years. That's a major tax bill all at one time. I know we're not on that part yet, but if we were abducted by aliens or struck by lightning and all of our money is in the corp, we're facing a major double and sometimes triple taxation threat to get that money onto the personal side to flow it out through our estate. And so we want to be prepared for those things and be aware. So, sorry, I digress. Back to compensation. A blend of salary and dividends makes a lot of sense. We want to have kind of a fixed salary. And so the maximum amount that you can get in RSP deduction every year, we typically line up our salary close to that. And then anything they need above that threshold, it can make sense to essentially bonus yourself and do a dividend. The down the road reason why you want to have that income threshold, it's about 186,000, 190,000 right now. When you reach like mid 40s, the equation for individual pension plans starts to tilt towards favorable. And so if you're a physician or you and your spouse are, we have a few of those where they both run clinics and they both are in the same profession, is you can do an individual pension plan or an IPP. And if you can both contribute to it and then both draw on it later, it becomes a family pension plan. There's a few advantages to that. But you can't do it unless you have a history of T4 salary income. And if you've been paying yourself dividends your whole career, your accountant might have to go backwards and refile taxes in order to get you to qualify for some of this stuff. But we want to draw some salary, fill your RSPs, fill your tax-free savings account, pay for your lifestyle, and then you can dividend out the money for bonuses, which we see a lot of our clients do for vacations, down payments for properties or investments that they're going to do, or, school or whatever else is going to happen. Man, if your kids play hockey, you need a big dividend every year to pay for hockey. I think that's about it. But it's usually a conversation, and we usually have to have some education onto why you would want the optionality.
Yeah. Really well said. Yeah. Shout out to the hockey parents out there, because that stuff is expensive. Every sport's like that now. It's crazy. All these sports camps are just money grabs left, right, and center now. Yeah. But anyways, maybe a different episode. But the other thing about it is, when it comes to the salary, it has some other side benefits. So Tyson mentioned about the RSP was a big one. And I know a lot of accounts will have the argument of, well, numbers wise, you could just earn more and outperform CPP by just leaving the money inside the corporation. So just do the dividends, opt out of CPP, and with the saved money from CPP and CPP2, you just leave the money inside your corporation and invest it yourself. We'll talk about the tax impacts of that in a second. But it's also good to have a diversified approach for retirement sources, especially things that are indexed to inflation. So if you project to have a lower life expectancy, then sure, if we have a pretty good idea of that, then the break-even number for CBP ends up being a lot further out. I think it's in like your late 70s, I think is the break-even point. But if you have a lower than expected life expectancy, sure, then we can, do a different plan for that. But for the most part, what we end up seeing is, in our space, in the medical professional space, there are longer life expectancies because of the profession, because the access to treatment, because the nutrition that you're able to afford with meal preps and better groceries and all that kind of fun stuff. So what we see, and we see this from our insurance actuarial side, is a longer tendency of life expectancy for these types of clients. So having a source of retirement income that is indexed to inflation, takes up the longevity risk, is fantastic. It is true that with CPP, when you pass away, you don't get that money back. Your spouse could get partial, depending their age and how much money they're making, all that kind of fun stuff. But yes, for the most part, it's going to go back and just stay with CPP, and then it'll just form part of that fund. Versus if you self-invested, you get to keep that money and then pass it on to the next gen after they pay tax and whatever. But it's not like you are picking one or the other. That is not the case, and that should never be the case. It's diversifying your income streams in retirement. And we talked about tax integration many times, but more or less, your tax bill is going to be about the same if you do dividends or salary or blend. Tax integration is tax integration. Your tax bill will be more or less the same. But it's what it provides you, which is what the difference is. And if you can more or less pay the same tax bill, and we can project out your retirement income. So even with CPP index, even with how much you're going to pay yourself from your corporation or your IPP or whatever that ends up being, if you're in a lower marginal tax rate or if you're in the same marginal tax rate, then it's all good. You're having another source of income. So there's many reasons why it can make sense. Another one is parental leave. So for this client, for example, she's a BC and looking to start a family, and there's other benefits. Like I know Josh is a BC, has parental leaves, and you can collect on your PDI insurance if you have a C-section and things of that type. But above and beyond that, if you can have EI income by, again, paying the same tax bill but unlocking another benefit, then that's another reason why having at least some salary starts to make a lot of sense. So it's not one or the other. That should never really be the answer. Definitive statements are always a pause in our industry that someone's like, you should always do this. You should never do this. Definitive statements are quite rare in our space. So that's never the answer. It's usually the answer is a blend of both. How much is scaled on one side or the other is going to differ from what you're trying to accomplish and what your marginal tax rate is now, what it's going to be in the future, and a bunch of other variables. But if your advisors or your accountant or your financial planner, investment advisor have only been telling you just dividend, it's worth asking questions. Why is that? What about this? What about this? What about this? And what are the impacts I'm losing out on, and help me project that out. And I think that's going to be a big thing that can really benefit you. So switching over, we talked about tax. Tyson kind of alluded to this, but and I guess I kind of did too when I talked about what the advice is for a lot of clients that we see, which is opt out of CPP and just invest in your corporation and just keep on doing that. There is a cost of inaction or misplanning when it comes to just investing and leaving all your money inside the corporation. So why don't we chat about that first, Tyson?
Yeah, I mean, I think some of the big missed opportunities, and so like I was saying, is you set your salary at a certain level, it's going to unlock RSP deduction room. So even if you don't contribute, maybe it's early days and you're paying down student debt, you're not necessarily going to look at contributing to RSPs. You'll start to compound that catch-up room. So that unused RSP contribution room could be there. You can always go back and fill it up, which means you could pull money from your corp, put it in your RSPs, and receive a large deduction in a single year or something like that, if there's a catch-up scenario. But ultimately, if you're a new practicing doctor, you're going to be at a level where it's like $32,000 a year of RSP contribution room, which $32,000 a year compounding over a 30-year career, that's a lot of money. And if you get 1, 2, or 3 doubling periods in your career, that's a great retirement cushion, especially if it's you and a spouse. The small business deduction grind. You were talking about this a little bit, but if you are very successful and you're earning quite high in your corporation, paying yourself a salary actually reduces the tax profile as well. So the tax burden is now on the personal side, less on the corporate side. Whereas if we just dividend that money out, it is efficient, but it doesn't lower the tax profile of the corporation. So sometimes we do it just to get back to that small business deduction limit, so you have less in the general limit for our successful, high-earning incorporated doctors. We talked a little bit about the long-term estate benefit, but the tax that a corporation could be impacted with at estate time. So not only do you, we don't have estate taxes in Canada, but we do have something called deemed disposition. So on the personal side, on the death of the individual, it's like we sold everything that we own for fair market value at the minute that you pass away, and then you get a tax bill assessed based on that. Well, in the corporation, you're the shareholder. So when the value of the corporation at the moment that you pass away, they crystallize the value of your shares and all of the capital gains, all of the stuff that goes with that. So you have to pay tax to liquefy your portfolio in the corporation. Then you have to pay tax to get out of the corporation, and then your estate may have to pay tax to flow that out. So I mean, that's a lot of tax that could be done there. So there are ways to plan for that. But if there's no planning, then $1 million in your corporation, your family might see $450,000 or $500,000, and it could be like quite a big bite. So that's a lot. Questions that we would ask. when we do our big financial plans, it's like, what's the projected lifetime tax bill versus are we optimizing for structure? Are we optimizing for tax? It's very goal driven, and we want to have the conversations with clients to see what are we trying to achieve, because we might be financial professionals try to achieve maximum optimization sometimes without talking about or aligning it with client goals. They might have very different short-term goals, and we do have a few clients where the goals change rapidly. So you're trying to build a structure and you're trying to build a plan, and the goalpost is moving. But in the sense that we're talking about long-term planning for clients, is we do want to align our strategies with the goals and with the timeline that we can foresee happening. For like, if they're going to be starting a family, you're going to be having children, there are things that are going to be happening, versus if we bring on a new client and they're 55 years old, they're not going to be having children. They've had their children already. And so their road forward has less unknowns in it. We looked at the expected value of the estate at death under an early scenario, under a life expectancy scenario, and then under like an age 100 scenario. Planning to live to 100 is a very common question that we get now, so we want to be aware of those things. And I think really just paying attention to all of the opportunities that are available. This is not sort of in my notes or in my thoughts, but we still see people, it's 2026. I still see people who are misusing tax-free savings account, and it's literally a savings account at the bank because they don't know what to do. They've never asked anybody. No one's ever stopped them and told them. And it almost seems criminal that you could have unlimited growth. It could double or triple or 100x in your tax-free savings account, and all of that growth is free. There's 4 tax-free things in Canada. That's one of them, and people still use it to hold cash. And, it's an education thing, but it's like, wow, underutilized opportunity.
And I mean, those are all some big numbers that can hurt you. And I kind of want to circle back to 2 of them. So when it comes to the estate tax on the corporate portfolio, so your leftover money that was inside your corporation that you didn't need on the personal side, that you invested and it grew and grew and grew because you weren't opting to RSPs, you weren't opting into CPP, you were just leaving the money in the corporation and investing it as an unlimited RSP as just an investment portfolio. Not only does that start to impact your small business deduction, but it can also add a very large tax bill. And in this example, it would have been quite large because I don't remember the cost basis for the client, but I think it was roughly around $500,000 would be what the trigger tax would be that would be added to the tax bill. But that could be quite significant as that just compounds over time. The client was only 38, so imagine life expectancy, let's say 87, how big that number could be. So it's important to get a grasp of what the tax treatment is going to be for your corporate portfolio. And the question isn't, what was my tax bill now? It's what is projected to be in the future based on my plans, and how can we mitigate that as much as possible by doing some proper planning. So just leaving your money inside the corporation and just deferring, growing isn't always the answer. The other thing I'll circle back to was we talked in the early part of the episode of, instead of just being a 70-30 and a 70-30, of rebalancing it so you're a full 70-30 in combination of your personal and your corporate inside your overall portfolio. And where do you hold that 30%? If you already, and it's kind of like a golf example or a lesson that I learned in golf, that if you have a bad shot, let's say you hit your shot and you're in the woods, just take your medicine, lay up back into the fairway, and then play from there. You already made a mistake. Just take your medicine and keep going, and don't have a bigger mistake. It's the same kind of idea. So if you are in a situation that you're already losing your small business deduction partially because you're over that passive income threshold of 50K, it's time to perhaps take your medicine, pun intended for those doctors out on the podcast. But it's a good time for you to take your medicine and then make some adjustments. So if we do want to rebalance that portfolio, that asset allocation, if you're already in the small business limit, we could just look at, all right, let's just trigger the gains that are sitting there and rebalance things. And this is really more appropriate for those that have too much equity exposure and need to get some more liquidity, and you have some unrealized capital gains that we want to look at selling. That could make sense for you. And if we can trigger that tax bill, but then also pay you a bigger salary to get a big deduction and then keep you into the small business limit. I know that may sound very complex, but we can walk you through that. But if you have to pay the tax bill anyways, you might as well use that opportunity to trigger the tax bill since you're going to be in that tax rate. Make all the rebalancing that you need to rebalance. and then you can solve that tax rate and hopefully get yourself closer down to the small business limit that you otherwise should be in, because you can create a large deduction for your corporation, which is a salary. That is always the easiest and the largest deduction that you can give yourself. And they can also take the benefit of the RSP contribution room, the CPP, and things of that type as well. So just because you're in this issue doesn't mean that it's unfixable. The good news is you have money, you've built wealth, and the better news is all the problems that you have are solvable problems. So long as you're healthy and you have time on your hands and you have the desire to make the changes, then they're all fixable problems, which is good. And sometimes you may have to pay a little bit of tax, sometimes you may have to do adjustments, but at the end of the day, it's a good problem to solve. So just want to come back to those 2 points about the small business limit and the corporate taxation. I know it may be very complicated, but it's always hard to do in just a podcast. So as always, if you guys want to chat about it, just feel free to book a call with us and we can kind of run through whatever concepts you're running into and problems you're running into, but just want to circle back to those ones. So as we wrap up, Tyson, let's chat real quick about some insurance and estate exposure, and then just kind of wrap up with some case study. If we have some time, we can go through some prescription pad before we get out of here. But we always say that your corporation doesn't automatically protect your estate, because without the right insurance, the structure, and the plans, the CRA is really your biggest beneficiary that no one really wants. It's like that child that no one really wants on their will. It's the CRA is just sitting there waiting for you to pass away so they can collect their money. So the good news, as I mentioned, everything is fixable. So people, I think, understand problems that they may be running into now. Let's talk about some solutions for them when it comes to the tax bill side of it.
Absolutely. You know, before I jump into some of that stuff, I mean, one of my favorite pieces from a different advisor, highly respected in the industry, he always says that you have 3 options when you pass away. You can give money to friends and family, you can give money to CRA, or you can give money to charity. And the good choice is you get to pick 2. So with proper planning is we can decide how much money is going where and how your family, friends, or your favorite charity is compensated. So this is not the charity episode, but strategic philanthropy is a really great relief for individuals who have means. You have stored value in your corporation, you have tons of money on the personal side, and you have a known CRA tax bill. Now we could plan for that and do something. All right. So back to our doctor that has tons of money in the corporation. What are we going to do? How do we get that out? Having corporately owned life insurance is a really responsible thing to do, especially if you have other people who are going to come behind you, inherit that money, and try and get access to that and remove those funds from the corporation in the most tax efficient manner should we pass away. Life insurance provides something to the corporate estate that most other things don't, and that is called the CDA. So your capital dividend account is a nominal account, which means it's kind of made up. It doesn't actually exist anywhere. Your accountant knows about it, but your tax exempt life insurance creates CDA room, which is a tax-free funnel to get money out of your corporation to the beneficiaries of your estate. So having the right amount of life insurance could actually mean you could get almost all of that tax-free out of your corporation to your beneficiaries with a little bit of planning, with some proper, projections and the right product in the right place. So if you have a operating company and you have a holding company and maybe you have a family trust somewhere in there, we just want to make sure that we're putting it in the right place, doing the right things so that the right money goes to the right people. The next priority that we see, and sometimes we catch it later in a career, disability insurance. You are of the highest earning individuals in Canada, and your ability to earn income and drive your wealth over your career is the number one risk that we really want to address. Should you get, I don't know, use this example all the time. You get struck by lightning, you're abducted by aliens, you're a dentist and something happens to your hands, you can't do the job anymore. You want to make sure that your income is insured so that your ability to continue to pay yourself over your career is there. And that could mean millions of dollars in disability income to yourself if it's set up properly. And we want to make sure that your family's protected. One of the first questions that we ask when we onboard a new professional is like, if you're working with other people and you have a practice or a clinic where there's other professionals, do you have a shareholders agreement? Like, what does that look like? Do you have the ability to exit your clinic or buy out a partner if they become a bad partner, or if you guys decide to go in very, very different directions? Is it pre-written rules of how you're going to disengage or dissolve that? And how do we do that stuff? So if your partner becomes, disabled, critically ill, or passes away, do you necessarily want to work with your partner's spouse and their lawyer? Probably not. So we want to have the exit written out and agreed upon, and then know how we're going to fund it. Sometimes you can fund it through a bank loan. They'll buy out your partner, but then you have another loan on the books that you gotta work through, and it might be a couple years before you're profitable again. Or you can use insurance. You can use critical illness insurance. You can use disability insurance on each other, and life insurance on each other, so that if something happens, you can buy out your partner's shares, and then their family is made whole, and then you get to keep the business whole, and everybody's made happy. So it does take some discussion, some coordination, but it is doable. Lastly is corporate wills and estate freezes. Most people don't know that you can have a personal will and a corporate will. And the reason you might want to have two different ones is you can name an executor on the personal side, and that person's going to wrap up all your personal affairs and file all your taxes and make sure that the estate distribution happens the way the will says it's supposed to happen. It's fair and equal. But on the corporate side, that person might not have any experience with business and not know how to wrap up business or what the value is to get the most value for the assets that you might be selling or the shares you might be selling, in order for the corporate estate to maximize its opportunity and be tax efficient and deal with all of the steps, because you're going to need a good accountant and maybe your lawyer and unwind a bunch of things. So having those pre-planned, in place, having the right people selected is a good idea. And then last one is estate freezes. And I know, like Vishal, we've talked about this with several family businesses. Very, very successful. It's been running for years and years and years. We have a few people that we've met at OptiFair, the BC Doctors of Optometry Fair, where there are several generations of optometrists in the family, which is really cool. But when you want to pass that down, how's that going to work? And if you know you're going to pass it now, do you want to freeze your tax bill and then pay yourself a little differently, and then the next generation can take over the business, and you won't have an unlimited tax bill? You'll have a known tax bill, and makes it much different for planning. And we see this in a bunch of different types of businesses, whether that's agriculture or manufacturing or some of the other businesses that we've come across. Sometimes the ability to freeze the tax implications for generation one make a lot of sense. We have a lot of real estate families that we've worked with that you bought a piece of dirt 40 years ago and now it's worth $50 million. Maybe we should have done a freeze at some point in time and capped the tax bill for generation one, so generation two can continue the growth, continue the business. So that's a lot. That's probably a whole separate podcast to go through detail on all of those.
Yeah, there's only two things I would add, and I want to be fair with our timing here, because we want to kind of review some stuff here before we get out of here. But the only two things I quickly touch base on is your disability insurance. So Tyson just alluded to the point that sometimes we see mid-career physicians or optometrists or dentists that don't have disability insurance yet because they were pitched it when they were just wrapping up school and you're on a very, very, very fixed income at that point. So you're like, oh, I'll just circle back to it. And then you just forget about it for years. And every time you hear about it, you're like, I just don't have time to tackle this. So that's one part of it. The other part of it is for those of you that did get your disability insurance when you were coming out of school and post-secondary. It's great that you have it, because you more times than not will have a permanent discount that stays in your policy forever, but you never increase it over time. So just as a quick reminder on this episode is every single year at your policy anniversary, you should be getting a letter in the mail from your insurance company, whether that be RBC or Manulife or Canada Life. You should be getting a letter in the mail saying it's your annual anniversary and you can increase your disability insurance. What that means is you can do so without having to go through medical underwriting again. They just got to see financials if you want to increase your disability coverage. And what we usually tell clients is you don't want to just get the highest amount of disability insurance just because you can. It's more so if your cost of living has increased. So if your guaranteed income that you need to make ends meet have increased, then that's a good time to look to increase your disability insurance to whatever that number may be, and whatever discount you had originally, you'll also get off your increase. So it's a really powerful discount that's available for you, and that's the whole benefit of you getting it done when you're finishing up school, because you get that permanent discount. So just a reminder on that one. And then one common thing that people mistake with the CDA account that Tyson was talking about, and an example of CDA is if you have life insurance and you pass away, and that opens up CDA room that your team can use to get money out. And that's more of the easy one. But when it comes to capital gains, we talked about that at the beginning of the episode. 50% of your gain is taxable capital gains and 50% of it is not, because it's added to your CDA room. However, in order for you to use your CDA room, it's quite expensive and you need to pay some accounting fees to do so. So that's why it's like a nominal account that usually sits there growing over time. And then usually, I don't know, like a decade or so, it can be large enough to actually justify spending the money for accountant to get the T-slips and do all that work to be able to use the CDA room. So it's not a year-by-year, transaction-by-transaction thing. It's just 50% of it is added to your taxable capital gains. The other 50% is sitting in your CDA account they can use later on, but it's not a transaction-by-transaction. It's sitting there for you to use when the cost justifies it. All right. Very technical episode, which we try and stay away from today. So we apologize. I think just taking a pause to apologize for all the technical jargon that's happening this episode. We talked about it before. We're like, before we jumped on, we're like, let's try and keep it more simple. I know it's hard to do, but we'll try and keep it more simple. We both agreed, and then we both kind of lost the plot on that one. So again, apologies in advance, or I guess not in advance, but apologies. So just to wrap up, with our age 38 physician that was earning the income, there's a couple of problems that she ran into, which was, the money's stuck, there's an invisible tax drain, and the estate exposure. So I don't know if we want to go into huge detail about Tyson, because I feel like we kind of went on a couple tangents, but maybe just a quick review would be helpful of where this physician found herself and what are the solutions to the problems that she's running into.
Yeah, I mean, so like some of the things that we saw, GICs, fixed income strategies in the portfolio. It's safe, but it was not efficient in terms of like what it was doing. And it was growing to the point where it's going to have annual impact on her small business deduction, because GICs renew yearly. The T-bills, the bonds, they pay out interest regularly. So it's not efficient. Passive income was $62,000 a year. So she's entered into that small business deduction grind area, really rebalance the portfolio, have it more, you could be responsible and be non-risky, right? Or less risky, but be more growth, capital gains focused. And this is one of the reasons why we work with some really, really great private wealth partners. They understand what we're trying to do, and they have really good allocations. That the like private investment counsel side of it is, the first rule is like Warren Buffett's rule number one with money is don't lose money. It's created and invested in such a way that it's not speculative. It is very responsible, long-term investing, but it is capital gains focused so that we can control those mechanisms. So we made that shift for her portfolio. It solves a lot of the problems. It does take some education, because most people don't invest because they think investing is risky. And so we have to add education to the situation. And when you all understand, you're all speaking the same language, the risk actually comes down by doing smarter things with your money. But we all have to be in communication. And I think that's what solves the first problem.
Yeah. And I think the reminder would be that a lot of your problems are solvable. So it's nothing that's, doom and gloom. Okay, I made this mistake and I'm stuck for the rest of my career. All your problems are solvable, which is great. And when you have the knowledge, you can then start to assess your own or diagnose your own situation and be like, okay, cool. Like, I think I need a specialist here, or I need help here, or I need to make these changes. So a couple of big things to keep in mind over for the episode, just to review, is that, the money that's inside your corporation is great, but you need to have a plan to use that money and to eventually pull that money on the personal side, understanding that whether you're alive or dead, that money at some point will come onto your personal hands. So that will trigger tax. And you could do that now by compensating yourself differently, or you can do that later by just deferring the tax and then having something like life insurance in place to cover the tax bill, or a pipeline strategy, which we'll talk about later episodes, or some other stuff. But there needs to be one plan. The answer isn't just opt out of CBP, invest the money inside your corporation indefinitely, and that's my entire financial plan. You're just going to compound and open yourself to a lot of problems, which the CRA will be more than happy to do, because they are your biggest beneficiary. If you have any questions, feel free to drop in the comment sections. Feel free to reach out to your advisors. And if you're on a dividend-only plan, ask your accountants, okay, well, what about these other things that I heard about? Why this over that? And just ask the questions that will make a lot of sense for you. And the summer is a great time because everyone's a lot more free in the summer. So that's a great time to do your housekeeping when it comes to your finances. So hopefully this helps in framing. This is the way that, it was a client that has the exact same problems. And this is really what we see is it's not just a one client thing. More times than not, when clients come to us and like, hey, here's the issues that I'm running into, or they don't even know what problems they have, like, hey, just assess my entire situation. Let me know what potential gaps I have. It's more or less the same gaps that happen over and over and over and over and over again, because there is a lot of reactive planning that happens in our industry instead of proactive planning and understanding that it's not your tax bill that you just paid. It's what's your eventual tax bill based on the goals you're trying to achieve. So when you want to get to this milestone in life and you want to access these funds, what does that look like? And then what does that look like? And then what does that look like? For those of you that are just listening, not watching, I was moving my hands further down that timeline. I'm a very handsy talker, so I always got to remember that not everyone watches the video version of it. But if you did, cool, that made sense. If you didn't, I'll just move my hands down the timeline. But we apologize for the jargon heavy episode. It was also a little bit longer than we expected. So we'll be back with a shorter, more concise episode next time. Spend a little bit more time on the prescription pad answering questions. If you want to get your questions in on this topic or other topics that we're having in the future, make sure you join our closed Facebook doctors group that has space for doctors across Canada to learn about these topics in a better way, ask the questions that you want to answer on the podcast, and so much more. And as a reminder, sometimes things happen and we have to move the episodes up or down. And when special things happen, we'll do special episodes. If you don't want to miss any of those, make sure you subscribe on whatever platform you're watching so you get that notification whenever the new episode's out, and then you can further educate yourself on everything it is to do with finances for those of you who are doctors in Canada. So with all that being said, appreciate you all. Look forward to our SpaceX episode that will be coming out very shortly here, which we'll talk about SpaceX, and then we'll see you on our regular scheduled programming in a couple of weeks. All right, take care, everyone.
Yeah.